let's shift over and talk a little bit about developer reputation and track record. So Mike, you've been in the lending market. You were a mortgage banker for many years. I'm sure you've dealt with many borrowers, some developers, some existing property owners. What are some of the kind of key things, if you're a lender, or an investor, considering a deal, what are some of the things you're really looking for, and why are those things just really important for an investor or a lender?
That's a great question, because I worked at a very blue blood, white shoe commercial bank, Crocker Bank. They were one of the big boys, the fourth largest in California. They made big construction loans on big institutional deals. And having had conversations with the chairman of the board, I said, what are you really looking at? I mean, just the real estate, right? I mean, if it's a nice building, you guys will make a loan on it. He goes, you know what? It's people first. Absolutely underlined it and said, look, you're in a commercial bank here. We're not some hard money lender, but we're loaning to people, good people. And honestly, the real estate was very much a second consideration in underwriting the integrity of a loan request. So people first. That's what I could tell you. If you got a guy that's got a track record of always paying back his banks and having executed effectively his business plans historically, that is by far the most important aspect of a consideration of a credit request, and the real estate is a second consideration.
Got it. And how does that kind of play out, in respect of a particular project? Like if you're going out to get financing for a project and you don't have a long track record, how is that going to impact your financing cost and number of lenders willing to loan you, and just impact overall likely success of your project and getting the money it needs to be built?
Very much so. The cost of the money is going to go up pretty quick if you don't have strong sponsorship. Yeah, you can always get money at a price. We know hard money lenders, loan sharks, there's always money available. It's just how much you got to pay for it. And so as you weaken the sponsorship and the strong guarantor of the request, the cost of the money will go up dramatically, which puts additional stress on the project to be successful, because the margin of error will narrow as the cost of capital goes up if you have a weak sponsor.
Right. And in your experience, underwriting a lot of these larger, construction loans, talk to us a little bit about, how, most loans are typically done, on a particular asset, right? Funds are being loaned, and the security of that loan is, the asset where the money is being used. How common was it to see, money being loaned to one asset, one address, but then having the security of that loan be secured by a guarantee from a much larger, separate entity that's also controlled by the project owner? How common is that? And kind of walk us through.
Well, it's a perfect world from a credit underwriter's position if he's got a very deep pocket sponsor. There's two sources of repayment when the bank looks at a deal. There's the principal and the real estate. Two sources of repayment. That's every credit at a commercial bank is underwritten and requires two sources of repayment, one from the sponsor and one from the real estate. And the sponsor really is the key to getting it through, the institutional investors. If you don't have the sponsor and that guarantee, then it goes down to the B and C quality lenders, and the price goes up quite a bit.
Got it. And so from a credit perspective, why, walk us through mechanically why, if I'm a bank, I want to make a loan that's not only going to the project, but it's also separately guaranteed by a larger well-capitalized entity? Like why am I willing to give lower interest rate, better terms? Why am I willing to give that person a better loan versus the guy, who's not giving me the parent guarantee and, it's not separately secured?
Well, the reputable developers with the long track records usually have a diversified portfolio. And so by having them on the hook, it actually reduces the risk to the bank substantially. If they're just looking at their subject property real estate and that specific project were to fail, they're stuck holding the bag because there's no secondary form of repayment from a strong sponsor. So by diversifying their exposure through the substantial experience and portfolio of the guarantor, the risk is substantially reduced.
Let's chat for a couple minutes about developers' access to capital. So Mike, how, if you're a lender or an investor, how are you looking to see if a developer, is going to be able to get a project done and has the money on hand, or is going to be able to get the money to finance something?
Well, you got to look at his track record. I mean, if he's one of the successful guys that's made it through the last 4 years of COVID and has, a track record of executing business plans, good times and bad, then you're going to think the guy's going to be able to do it again. I mean, history tends to repeat itself. That's why they call you having good credit and bad credit. So has he had a track record? If he's a newbie right now trying to source project financing, I'd be very skeptical. I would, because just getting the A piece, the bank loan, is going to be really tough. And then, of course, getting the equity as you go up the debt stack gets even harder. So it just depends a lot on his track record.
And how important is it for that track record to kind of include, periods in the past where, there were corrections, the financial crisis? Like how important is it to have, had a lot of projects going on during one of those times and, been able to perform on everything and make it through the tunnel?
I think it's the most important thing. If a guy's been around long enough to have been through the last tough cycle, say in 2008, right in there, 2009, when the bank took back a huge amount of REO foreclosure product, if the guy made it through that cycle, then I think he can make it through this cycle. I think that cycle was tougher than this cycle is. So that had a lot more foreclosures than I think this cycle will have because there's lower leverage here on most of the properties.
I don't know if you're asking me what specific markets, like what states and cities I would recommend, but I'm reluctant to say that because it depends very, very much on the experience of the developer. If a guy really knows his market, he can make money in any market. He's got a lot of experience. A guy that's really been fantastically successful in one place might go, oh, well, now I want to go to XYZ across the country in a city I've never done anything in, and he might be surprised at his lack of success.
Sponsors an experienced developer with a long track record. Like what, for someone who's, developing real estate, on a regular basis, Mike, what does that look like?
I mean, as far as how long?
How much total, development, dollar projects, like what's
relative to the size of the deal, but I mean, 10 years of doing it, I think is kind of a minimum, let's say a guy's been doing it for 10 years. Okay. Yeah, that's a good developer. A guy that's been under 5 years, that's a newbie. And, these are just broad statements, but, how many deals have you done like this before? Well, no, I've never done one like this before, but I've done some that are similar. I mean, it's an art. It's not a science. It's not an exact thing. But I mean, the more a guy's done deals just like this one, the better off you're going to feel.
And the more those types of deals that have gone well, completed, and now this is, a carbon copy.
Certainly makes it easier to underwrite the risk, yes.
And Dave, talk to us a little bit about, cost of capital, and, obviously that's going to be intertwined with, performance, track record of prior deals. as well.
Okay, I wanted to say one thing about what Mike just said, which is the length of the time of the experience of the developer is very important, but it's also, has he gone through hard times and still been successful? In other words, everyone looks like a genius during a market that's on fire and going up. You buy, you flip, you don't do anything, and you sell it for a profit, and the guy looks like a genius. How do the guys do when there's a downturn? That's the real test of the experience and quality of the person. So you'd want to see a guy that a developer, anybody else you're investing money with, have they experienced and handled the good and the bad times successfully? So as far as the number of years, I suppose it depends a bit on the length of the market cycles, but yeah, 10 years or more certainly. And again, remember that it's risk reward adjusted. In other words, everyone could go out and buy, let's say US government securities. They're the lowest risk thing on the planet. There is no risk. It also pays the lowest return. So it's really a matter of trying to get a higher return without taking on too much more risk. So do you consider a developer that has a pretty good track record in exchange for a potentially higher return? Or do you go with a guy that's solid gold, but he's not going to give you a very good return, but you'll probably get it?
You mentioned reputation, for investors, who aren't very familiar with real estate developers, Mike, what does a good reputation look like, and what does a bad one look like, and how do investors, kind of quickly figure out, does this developer have a good reputation or a bad one?
Well, first of all, you look at the amount of money, let's say he's borrowed over the last 10 years and how much of it he's paid back. If he's borrowed $1 billion and paid every penny of it back on time, sign me up. If he's given 2 or 3 deals back to the bank, probably a big red flag. I mean, it's like a credit report. What is his credit report? Has he paid back his banks on time and in full? Well, no, he had one deal where he had to extend a year or 2, but eventually paid it back. But in this meantime, he's also executed 8 other good deals. That's probably okay. But if he's handed the keys back to some banks over the last 5 or 6 years, I'd be hesitant to do business with them. I think the markets come and go, but great sponsors don't come and go. And I think that's really significant. That's why the big banks look to the sponsors almost more than they look at the real estate.
Dave, what are some of your thoughts on this?
Yes, I completely agree with those points Mike made about sponsorship. That's the number one issue. And a guy that has that track record isn't about to run a career with one bad deal, and that can happen. And if you have a bad deal, boy, it'll be hard to come back with your hat in hand to your lenders and your investors in the future if they've had a bad experience.
We'll shift gears now and chat a little bit about one of our current EB5 projects. So one of the projects that we're currently working on is our Twin Lakes Rural EB5 loan project by Coulter. Coulter is one of the largest developers in the Southeast. They've worked on over 20,000 single-family homes. Mike, how does that kind of borrower track record, compare to some of the deals you've looked at over the years?
I think it's a very, very impressive track record. I think the fact that they borrowed from what you call money center banks. I've dealt with these banks, PNC. They're one of the biggest construction lenders, very conservative. I ran some deals by them. They're very particular. Of course, we know Wells Fargo is about as particular as it gets. So these are big boy banks that only loan to top tier developers. So very impressive.